Hey, welcome to this week's video. In this week's video, I want to talk about 7 ideas you can learn and use from the tax returns that were filed by Trump. This video is not meant to be political, but it's meant to give you some ideas that you can actually use to save money on taxes. So let's get to work. So let's take a look at 2016. You can see here that his taxable income was zero and Trump paid $750 in tax. And in 17 was the same result. In 18, he actually had income of 22.9 million and a tax of about a million, or 4.3% of that 22.9 was paid in taxes. And in 2019, he had 2.9 million in taxable income and he paid about 760,000 in taxes, or 26% of that 2.9 million. In 2020, he actually had a loss of 16.2 million and paid no taxes in that year. And in 2021, he also had a loss and paid tax of zero. So you might be asking, how's this possible? Trump has a 757 jet, which is very expensive compared to a normal private jet. And there's other things that he has, like lavish golf outings and hotels and things like that. How is this possible that he pays so little in taxes? And is this the reason why he didn't want his tax returns released? Really, the question is, what does this have to do with you? And what it has to do with you is that in some of the strategies that we'll go through today that Trump may have used in his tax returns to reduce his tax liability quite significantly, you can also do the same things in your tax return. So first, let's talk about active, or what's called non-passive income versus passive income, and why this is important. Passive income is income that you earn, but you don't necessarily trade your time for that income. Such things as like investments, like stocks, and in certain cases, rental properties that you own. Non-passive incomes are things that you do trade your time for that income, such as a W-2 job or a business that you run and that you materially participate in, and possibly that rental property that you own. So you might be asking yourself, what is the big deal? Really, the big deal is that in certain cases, the non-passive income, you can offset your losses against that income. And in some cases, you can actually exceed that income to generate a net operating loss, which we'll talk about. And you saw on the results from one of the years of Donald Trump's tax return. So let's say that you have a passive loss from a rental property where you lost on paper $40,000. And let's say that you have W-2 income and business income that total about 200,000. Well, if you remember, I said that you can't take passive losses beyond passive income in certain cases. And in this case, we're showing that you cannot take that 40,000 in loss. And the result is that you're paying about 35,000 in taxes. Now, let's say that you're able to take that $40,000 in loss, and that now reduces your income to 160,000, and you save almost 9,000 in taxes. But if you actually invest that 9,000 over 10 years at say 7%, or you put that in other properties or other assets, you can actually end up saving almost a little over 17,000 in taxes. So you can see how it's powerful it can be if you can take that passive loss beyond income and offset that against your active or non-passive income. So the first way you can do this is by classifying yourself and qualifying as what's called a real estate professional. And this is an individual who meets specific criteria that's outlined by the IRS. It doesn't mean that you have a real estate license. And this matters because if you are classified as a real estate professional, you may be able to take some of that passive loss that we showed in the example and offset that against your active income and thereby reduce your taxable amount that you owe at the end of the year and the taxes that you pay to the government. So, in order to be able to do that, there are two things that you must do. The first is material participation. To qualify, you have to be able to spend a significant amount of time in the real estate industry. And what that really means is that 50% of your total workable hours in a year would be dedicated to real estate type industry activities, such as rental property activities, or it could be such as construction or development. But basically, it's in within that industry. Once you get that, then the next one is that you have to actively participate in the rental activities that you have and that you are invested in. And in this case, you could actually combine yourself with your spouse to actually meet that active participation. I just want to get you the idea that if you do qualify for this, then you have a good chance of being able to take some of those losses that you've incurred and offset that against your active income. If not, those passive losses just sit there until a transaction occurs, like the selling of that property. The good news is, though, if you have passive activity and you have losses, you can take those losses against other passive activities that you have, other investments that are passive. So you do get a little bit of benefit, but if you're able to take that passive income and make it into active income, then you get the most tax savings. So, second, let's talk about depreciation. When it comes to filing taxes on rental properties, you'll start with your total rental income, then you'll subtract obvious expenses like advertising, insurance, interest, maintenance, repairs, professional fees, but then you get to take depreciation deductions. Depreciation really is the process of writing off the capital asset over a period of time, such as the rental property itself. For residential property, that would be written off over a period of 27 and a half years, and non residential, it's 39 years. Depreciation is really valuable because it's not an actual expense that comes out of your pocket, it's a non cash expense that you can take. And when you think about it, most, if not all, of the deductions that you take in your tax returns are resulted from cash that comes out of your pocket. So depreciation is extremely valuable if you're able to take that deduction, and especially if you're able to take that deduction and create a loss for that property and offset that loss against active income. Now, the next area is the raw land of the rental property that you own is not able to be depreciated. But what about land improvements? Those can be. Those are like driveways and sidewalks, landscaping. All that stuff deteriorates over time and it can be depreciated shorter than 15 years. What you can also do is break out personal property. Personal property includes all sorts of assets that you can break out to boost depreciation expense. So why is that valuable? Well, if you had a property, let's say the land was 300,000 and the property was 700,000, well, that 700,000, if you remember I said, could be written over a time period of either 27.5 years or 39 years. If you're able to take that 700,000 and break it down into personal property and you are able to slice out, let's say, 200,000 of that 700,000 as personal property, that you could actually accelerate the depreciation quite faster than the 27 and a half years or 39 years that I mentioned earlier, then you get a bigger deduction that you can take to offset other income in your tax return. Another area is repairs versus improvements. Now, repairs are deductible immediately as you make them. Improvements are, though, depreciated over a period of time. So it usually makes sense to characterize fix ups as repairs so that you can deduct them much faster. Now, the definition seems relatively straightforward, but anything with the IRS is not relatively straightforward. Repairs keep your property in good operating condition, they don't add value, and they don't prolong the property use. Now, IRS examples include things like painting, plastering, repairing broken windows. Improvements, on the other hand, adapt your property to new uses, add value, or prolong its use. The IRS examples include like room additions, new landscape. So it's very important that you're able to break down the repairs versus the improvements, and so that you may be able to get a bigger deduction if you're able to classify whatever you did to that property as a repair versus an improvement. So now let's talk about net operating losses. This occurs when an individual's deductions exceed the income in a given year. That negative income can be carried forward, meaning it could be applied to a future year that you have income to offset that income. Now, net operating losses probably and most likely occur when you're a real estate professional or when you're in that industry, when you don't have any other income like a W 2 income or a business income. It's all related to the rental properties, and you have that cost segregation or depreciation expense, then those non cash items that actually will cause you to have a loss for that year. Now, remember when I talked about earlier that when you sell the property, you have to recapture some of the depreciation and you have the lower basis, which would cause you a higher gain. There's one way that you can get around that, and that is called a 1031 exchange. This refers to a provision really in the US tax code. And it's what it is it's the exchange of one investment property for another. And it's deferring that capital gain that I mentioned earlier to a future year. Now, the rules for 1031 exchanges are rather quite complex, and you have to make sure you follow them to the T. One is the identification period. After selling the property, the investor has 45 days to identify the new replacement, the like kind replacement. The exchange period, along with the 45-day identification period, the investor has a total of 180 days from the sale of the original property to complete that acquisition of the replacement properties. But the bottom line is 1031 exchanges can help save you a ton of money on capital gains tax. Now, the next area of savings is what's called opportunity zones. And these are designated geographical areas that's typically low income communities where investors can receive tax benefits for investing capital gains from the sale of the properties into qualified opportunity zone funds. And why does this matter? Well, you get a temporary deferral by investing the capital gains into this opportunity zone fund. The investor can defer paying capital gains on the original investment until December 31st, 2026, or until the investment in the fund is sold. So, bottom line, what does this mean for you? Well, it means that you are able to utilize some of the things that Mr. Trump most likely used in his tax returns, and you shouldn't shy away from that. Of course, some of these things are quite complex, but they are definitely doable by the average investor and the average business owner. And we're here to help if you have any questions on it. Actually, we have an ebook on the top ways that real estate investors can save on taxes that I'll link in the description. And I've actually also done a full 45-minute training on this as well that might help you out that I'll put down in the show notes. So that's it for this week's video. If you got any value out of it, it'd be great if you hit that thumbs up, and I will catch you on the next one.